I have a very special guest today, Orest Tomaselli. Orest is with a company called Condotech. I think they are probably the number one or largest condo approval company in the United States. There's been a lot of recent changes to the condo guidelines. So I asked Orest if he would kind of go over them with the realtors. So you guys are up to date on all the latest and greatest. Orest, you want to take over?
Yeah, thank you so much. Yeah, absolutely. And thanks for the folks who are joining this presentation. So, this is an interesting time in the marketplace. And I spent some time putting together what I thought were the appropriate pieces of information for realtors as they pass through the condominium approval and or review process through their sales and listings. And the way we really kind of thought about this was to make sure that realtors had an understanding when they're selling or listing a condominium unit, that there's a lot that goes into the review of that, the building that the unit is in, the project, like we like to call it, to ensure that it's compliant with lending guidelines. And without that compliance, it's virtually impossible to get mortgage financing in that building. And there are some severe results from that. So recently, Fannie Mae introduced new lending guidelines, and Freddie Mac followed shortly behind them. And I'm going to outline a little bit of how that is going to impact you going forward. So firstly, about us, and not so much about me, we provide condominium project approvals and warrants to most of the lender world and most of the lender industry. And we do that, and I'll tell you at what point in time we do that at Condotech, when a loan is originated and after you essentially, or sometimes prior to you signing a contract, and most of the time it's after a contract is signed on a condominium unit, we get an order to provide our lender clients with either all the documentation that's required for review of that development, and or we are hired to provide a review of those documents we collected. And those documents include the condominium questionnaires and operating documents and insurance documents on the condo. So we're very good at that. My history is that I owned a company called National Condo Advisors for 13 years, which was really prevalent in the industry, which was just acquired by Condotech at the end of last year, at the end of 2021. So it's important that you understand that that's our role, because a lot of the decisions you will see or have seen in the past and will see in the future are going to come from our review team as we review these condominiums for compliance. So what's the hubbub? What's the big deal? Both Fannie Mae and Freddie Mac, the two largest insurers and purchasers of residential mortgages in the United States, have changed their lending guidelines for condominiums and cooperatives. And they, just to give you an idea, over the years, there has been, minor changes that have come out from these agencies, but nothing that's caused, a large percentage of condominium developments to be denied for financing. And these guidelines came out because of, and as a direct result of, that tragic collapse of the Surfside condominium development in Florida last year. And, there's a lot of arguments as to, who's at fault in that condominium development and why it fell down, if there is anybody at fault. But when you really delve deep into why that condominium collapsed, you'll find that for 20 years, the condominium board kept on pushing away the repairs and maintenance that were supposed to be performed within that development and kind of kicking the can down the road. And the reason they were doing it was because they knew there were structural issues with the development. And the reason they were doing it was because they did not want to create a special assessment for the unit owners. And that's a problem when you have a small volunteer board that typically doesn't have experience or expertise in construction, in the infrastructure of a building, regardless of how big or small that building is. it creates issues. Now, typically, a property management group would come in and advise them appropriately. But at the end of the day, the decisions to do work or handle the appropriate repair work in a building all comes down to the condominium board, which was elected by the owners. So these new Fannie Mae and Freddie Mac guidelines are as a direct result of that condominium collapse. And both of these agencies have specifically outlined that. They came out prior to the end of last year. They went into effect on the Fannie Mae side on January 1st. And on the Freddie Mac side, they go into effect on February 28th, on Monday. Lenders are already looking at these guidelines and underwriting condominium projects to these new guidelines. So what's been addressed here? What's been addressed is, I think one of the biggest things that's come out of these new guidelines is an unavailable status that has been created by Fannie Mae. And essentially what this is essentially, is that Fannie Mae has said that if we review a condominium development and it is not compliant with our new guidelines, we're going to put that development on an unavailable list. And I'm going to get into why that's such a big deal in a couple of minutes. But it is certainly one of the most major things that's happened in the industry, because it impacts, as soon as a condominium development goes onto that unavailable list, it impacts every single owner in the development and literally shuts down that building or that condominium development for mortgage financing. So, as you can imagine, it's a pretty big deal as a realtor if you have a listing in a building that's unavailable for mortgage financing. So that's the first thing. They've also eliminated new construction reserve studies allowances, and we'll go into what a reserve study is in a minute. They've eliminated established reserve study reviews by lenders, meaning that if there is a reserve study on a development, that the lender can no longer review it. It has to go through this complicated, larger process of submitting the whole entire development to Fannie Mae for approval. It's called the PERS approval. There's an incredible focus on infrastructure, on the construction of the property and what the property looks like from a structural perspective, on whether or not it's in good condition or bad condition. And there's an incredible focus on the finances of the building, special assessments, whether there's enough capital that's being set aside for reserves for repair and maintenance. So these two agencies, as I said, control most of the lending in the United States, and all other lenders, all other investors in the marketplace have essentially aligned with these guidelines as well. So that's the issue, and let's delve into it a little bit. So what you need to understand is that there are several different types of lending for condominiums and cooperatives in the industry, and they're unique to these types of property types. It's very different when you're buying or financing a single family house as opposed to a condominium development, because on a single family house, you do an appraisal, and whatever issues arise from that appraisal essentially are going to have to be addressed by the homeowner in the future. But because there's a complicated ownership structure, or more complicated ownership structure in a condominium development, it means that somebody else is essentially going to make the decisions on whether or not to do these repairs to the development. So the lending's different. And what's available out there is Fannie Mae, Freddie Mac, and those are kind of interchangeable, meaning that typically if you're compliant with Fannie Mae guidelines, you'll be compliant with Freddie Mac guidelines and vice versa. But these guideline changes made that a little bit different for condominium developments, where Freddie Mac will still allow a development, as I said, to use a reserve study, and Fannie Mae will not for a review or an initial review of the condominium development for lending. There's portfolio, balance sheet, or what they call non-QM mortgage financing in the industry. And this is a secondary market offering, meaning that there are investors in the marketplace that a lender can go to, that they can sell a non-warrantable or a non-compliant loan to. And, that's an interesting part of the market right now, because these balance sheet or non-QM investors are also looking at this unavailable list, as I mentioned, and really they're hesitant to lend in projects that are on this list. There's also the FHA, the Federal Housing Administration, and the FHA has a couple of different approval processes. There, you can actually get a single unit approved within a condominium development, or get a global approval for the development. The single unit approval and global approval, which they call the HRAP approval, are interesting because they require the same exact thing. So most condominium developments actually opt to do a global approval so that they don't have to go through the process over and over and over again. And there's a limit to how many single unit approvals can be done within any project. So why that's important for you is if you have a listing in a condominium development or selling a unit in a condominium development, if you don't have a global approval, and that's something that we provide at CondoTech for condominium associations, you may not be eligible, your borrower may not be eligible for FHA mortgage financing. And if there's a global approval, they may. So there, we typically recommend that developments go for the global approval and not the single unit approval, because it's virtually the same exact process. Then there's underlying mortgage lending, which is specific for cooperatives, and that is impacted with these new guidelines, where underlying mortgage lenders are really unwilling to provide mortgage financing for cooperative developments that aren't compliant. And there's CIRA lending. So CIRA lending is commonly known as common interest realty association lending. And what that means is that there are loans specifically available for condominium associations, not specifically on the unit, but for the entire building that can now be provided to do some repair work to the building. And those lenders are really not, are really aligning with these new guidelines and not willing to lend on projects that aren't compliant. So that's impactful for everybody on this call. And why is it impactful? So lenders are now required to make determinations about, whether or not a project is eligible by collecting a lot of the documents that, the operating documents on development, the insurance on the development, a questionnaire on the development. And there's now a detailed review and a secondary addendum to these questionnaires that has come out that is required for any loan to be provided in a condo building. And that secondary part of the questionnaire really focuses in on special assessments, violations, reserves, capital balances, and board initiatives on whether or not repair work is going to be performed in the future. So it's very interesting because a lot of people in the industry don't really realize how this can essentially make or break a condominium development and really have an impact on the value of units within those developments. So before I get into the unavailable status, I do want to share a quick story with you guys. I'm often asked to provide commentary for, large, national, journalists that provide, that essentially provide or write stories about the mortgage industry and or condominium lending. And recently I was doing an interview with a reporter, and he said, well, what's the worst case scenario that you've seen happen since these guidelines came out? And there's a funny story, not so funny for the lender, but there's a funny story that, in our organization, it's, we have, kind of like a list of, what's the weirdest thing you've ever come across. We had a lender call us on around January 7th, January 8th of this year and said, hey, Orest, I have a problem with this condo development. I closed the loan in this development and I didn't deliver it to Fannie Mae. And I said, okay. He said, well, I closed it in December and now it's January. And, they're now asking for the updated condo questionnaire. And I said, all right. And he said, well, we got it. And the problem is that there are all sorts of problems in the parking garage of this building. So what are the issues? He said, well, There is concrete spalling, which means that concrete is like, on a ceiling, or the wall is, kind of coming apart and falling. And there's all this concrete falling in the parking garage that's under the building. I said, all right. I said, well, there's exposed rebar, and already I'm getting, the hints of what's happening. So a couple of years ago, he said the association went out and installed these metal plates to sit above the cars, right under the ceiling, so that when concrete fell, that it didn't hit the cars and cause a problem. So I said to him, I have to tell you, there's nothing you can do. What you're describing is, multi-million-dollar cost for the condominium association, which is going to be borne by every single unit owner. Every single unit owner is going to have to contribute to that repair work. And it was just comical for me, because instead of fixing the problem, the association installed steel plates so that the cars wouldn't get hit by the falling concrete. And this is, in an era where we just saw a condominium development collapse. I mean, I think everybody has seen that video, based upon structural issues. So it's one of those things where, I couldn't believe that I was having the conversation I was having. I couldn't believe that the condominium association was, so remiss in actually providing, the repairs that were necessary in this development to the structure. So the point of that story is, it's really important that associations understand how impactful this is. So Fannie Mae's unavailable list is one of the first things that I mentioned. It is incredibly impactful. There are over 995 condominium associations across the country, and I think that number is much higher now. This was at the end of January. In the first 30 days, 995 condominium developments went on the unavailable list for Fannie Mae. So it's a giant number, by the way. They did it in 30 days. And we actually couldn't figure out how they did it and how they came up with all that data so quickly. We think that they were kind of, warehousing all of these sites to put them on this list, and they came out with the guidelines. Or maybe it is as a result of individual reviews. We're not sure. But that means that 995 condominium developments have literally and virtually no access to mortgage financing. And that's a problem. So if you were to sell a unit within that development, that purchaser would essentially have to have cash in order to buy that unit. That CPM process, or what stands for Condo Project Manager, is essentially a software system that Fannie Mae has that seller, servicer, lenders who sell or service their loans through Fannie Mae have access to. So even this unavailable list, although this unavailable list exists in the industry, it's not something that the public can really tap into and find out. So if you're a realtor, it would be really difficult for you to find out whether or not a building is unavailable or not. Just prior to listing a unit or selling a unit within that building, unless you would be able to get a lender to actually find that information out for you. So there's a way to get off this unavailable list, and that is, again, to submit the condo development through the CPM process, through the PERS process of approval, which is a global approval with Fannie Mae, which is not only costly, but can take 30 to 60 days to actually perform. But the issues that made the condominium development unavailable have to have been rectified. So we're going to go into those and let you know what those issues are. Before we do that, just to understand the reserves and reserve study, I told you earlier that I was going to outline what a reserve study was and how that impacts condominium operating budgets. So if a condominium has 100 units, okay, and has, let's say, a yearly operating budget of $1 million, it means that the reserves that Fannie Mae requires is 10% of that operating budget. So 10% of $1 million is they want to see that $100,000 a year is listed as a line item in the operating budget, and that those funds are specifically titled reserves, and that those funds go into a segregated account And the funds within that account can only be utilized for repair and maintenance to the common area components in the building. So this guideline is not new, but it has been in place for a long time. But Fannie Mae and Freddie Mac have kind of shut the door to any type of lending or any type of lending approval process that would be able to avoid this 10% contribution. So there are different types of lending approvals for condominium developments, or there were in the past limited reviews instead of a full review. And essentially a limited review, you could avoid the checking of this 10% reserve line item. So across the country, a lot of buildings just didn't comply. So Fannie Mae and Freddie Mac have shut the door to that and now require a 10% line item in the operating budget for reserve. So that's very important because it's one of the first identifiers when we do a review of a condominium development to determine if it's compliant or not. And after January 1st, if you don't have a 10% line item for reserve, you're essentially non-warrantable. A reserve study is utilized in many condominium associations. And what that is an inspection report, typically by an engineer, that goes into a property and looks at every single condominium common component. So all the mechanicals, the roof, the facade of the building, the hallways, anything that's outside of the actual unit, and assigns a condition assessment to that specific component, a cost to repair or replace that component, and that's done over a 30-year horizon, and essentially comes up with a prescription for the appropriate amount of reserves that particular building has to set aside. And in many instances, the reserve studies that are performed on a condominium development will result in less than a 10% line item for reserves, especially on newer condominium developments. But Fannie Mae has clearly outlined that they are not going to accept reserve studies that have less than a 10% line item through their normal channels of lender review, and require those projects who are reserving less than 10% and have a reserve study to be submitted directly to the agency through their global PERS approval process. Freddie Mac, however, is allowing reserve studies. So again, this is kind of a specialized outline on this call. But I will tell you that a lot of lenders are now pushing condominium loans through Freddie Mac instead of Fannie Mae because of this issue. But that's not the only problem with these guidelines. There are several other things that have come up and that are required of condominium developments, which we're going to get into. So the big one, deferred maintenance. So Fannie Mae has outlined, and this is specifically as a result from the Surfside condominium collapse, that any issues in the development that can affect the habitability of a unit or the enjoyment of a unit essentially are elements that will reject a condominium development from being able to be approved. So there are a lot of buildings, and in the example I gave you earlier about Surfside, that have deferred maintenance. And what that is essentially, components that haven't been repaired or replaced that could eventually impact the habitability of a development. So examples of that are, an internal structure in a building, like let's say the walls or the ceiling of a parking garage, where you see spalling concrete, or where you see exposed rebar. It could be the exterior of a building that hasn't been maintained, whether it's painted or whether it's rotted components replaced. It could mean that the roof wasn't replaced and that there are leaks in the roof. So there are a lot of things that are kind of covered under this deferred maintenance category. And Fannie Mae specifically states that if there's deferred maintenance in a development, that they will not allow mortgage financing on that development, and will likely put that development on the unavailable list because of the deferred maintenance. So there's ways around this. Essentially, the condominium association has to do the work, or they have to have enough money to do their work. And in most instances, the work has to have been performed prior to mortgage availability, but there are certain instances, like I'll give you an example. We had a building with an HVAC unit that controlled, the heating and the air conditioning, and the unit was a split system, and the air conditioning wasn't working. Well, this is a building in the Northeast, and they started doing the work on the air conditioning part of the unit in sometime like October, but they were going to be done with it by the end of March, prior to the air conditioning unit, it being needed by the homeowners. So in a building like that, typically it's a rejection, but because we were able to prove that the association had enough capital to do all the repairs and didn't have a special assessment that was going into place, we were able to get that site approved. So a unique instance, but that's the, and it goes part and parcel with this whole deferred maintenance issue. So this, or I should say the third thing that's a major issue here is special assessments. Special assessments have always been an issue when determining whether or not a condominium development is compliant. And so let me break this down for you. What is a special assessment and how does it work? There are many parts of the country where condominiums are located that operate almost exclusively by special assessment. And what that means is people keep their maintenance payments low. And when there's a need for a repair to the building, they get a couple of quotes and they come up with a number of what the repair is going to cost. And then they divide that number based upon all the number of units within the development. And they essentially provide each unit owner with a bill for that, capital to be collected, all right? A bill to do the repair or maintenance work. And often a special assessment will last for, a specific period of time. Like, they don't charge you all at once, although you do have the ability to pay that bill all at once. Typically it's over 12 months or 24 months, because when you operate in the special assessment world, you typically give unit owners enough time to understand that the special assessment is in place and that they don't get hit with an $8,000 or $10,000 bill. But Fannie Mae now is really, really looking into special assessment, saying, okay, if it's for a deferred maintenance item and it hasn't been repaired or replaced, as I went over earlier, then you're ineligible for financing. If it's for an item that has some sort of adverse impact to the habitability of a project, so if you can't live there based upon that repair being performed, then that's a no-go. And what they're trying to figure out is how much money these developments actually have and what the financial impact of these special assessments are going to be for the homeowner. So I'm going to give you the reason why this is so important. When you qualify somebody for a mortgage, you qualify in a condominium development, you qualify them based upon their maintenance payments and their mortgage payments added together, right? Along with their insurance and monthly insurance costs and taxes. And in a development where you have, a special assessment that has been, levied on the unit owners, let's say after somebody has gotten a mortgage, then you're qualifying a person based upon the wrong number, because you're qualifying a person based upon what was, not what is. And what you would have to financially qualify them for is, not only their mortgage payment and their maintenance costs, but also the special assessment. So Fannie Mae is looking at this saying, well, if we're qualifying somebody and then the next month they have an extra $1,000 a month that they have to come up with for a special assessment, then they may not be qualified for that mortgage any longer. So there's a lot of things that have to go into place here, or go into process here, in order to review these special assessments. And that's something that CondoTech does as well for our lender clients. But it's really important for you to understand this, because, when you list a unit within a condominium building or sell a unit to a purchaser in a condominium building, these are the questions that are going to be asked. And you want to know up front whether or not that building is compliant. So one of the questions you may ask as a realtor is, is there a special assessment currently in the project? Is a special assessment coming? And do you have a reserve study? And we'll give you a little bit of a list a little bit later on to ask your condominium developments that you're working in. The next issue I kind of highlighted a little bit earlier, which was, this new questionnaire that's come out. And there's an addendum to condo and co-op questionnaires that ask an enormous amount of additional questions about the structure of a property. Well, I shouldn't say an enormous amount of questions. There are more questions now about, the structural condition of a property, deferred maintenance, special assessments, what the deferred maintenance is, what the special assessment is for, as we've outlined, and what's going to happen in the future. What's the future outlook for this development, essentially was what they're trying to find out. And there's a lot of information that's typically required for this, to provide these answers on this questionnaire. And what we've seen recently is that condominium board members are unwilling to answer a lot of these questions because it increases their liability dramatically. As an example, if they don't have a reserve study on the project, because how do they know whether or not the structure is sound? How do they know whether or not there's an issue with with that structure or the habitability in the future? So we've been recommending now to our condominium clients, and our company is structured where we work with lenders primarily, but we also have a whole retail division that works directly with condominium associations, where we provide, Fannie Mae approvals and FHA approvals, global approvals for the whole entire development. And what we're essentially telling our condominium boards is, you guys need a reserve study, because you need to be able to answer these condominium questionnaires appropriately. And the only way you could do that is by doing it through the vehicle of having an engineer come to the site and look at these components. So this questionnaire is causing major issues in the industry, and it's requiring a lot of additional information. And it's also slowing the process for approval of condominium loans. So you need to know that as well. So that liability that I just outlined is really massive. There are a lot of attorneys out there saying to their condominium boards, don't answer these questions. Don't answer these questions without a reserve study report. Don't answer these questions regardless of who the unit owner is, regardless of the loan. And of course, that is not only slowing the process of approval in the industry, in a lot of cases, it's eliminating virtually any way to get mortgage financing in these developments. So the point here is, you kind of have to do your homework when you're listing a unit or selling a unit within one of these developments. You got to make sure that the board has addressed these issues, that they've dealt with this. And again, these are pretty new guidelines. So if I could even estimate, I would estimate that probably 10 to 15% of developments have even addressed this in any shape or form. So I think that that's coming in the future. There's kind of a reckoning coming where a lot of developments are going to have to address these new requirements. And I think you're going to find a lot of developments that aren't compliant here. So what are our recommendations? We put a lot of thought into this for the realtor, an agent world out there, real estate agent world. And we were trying to figure out a way to make sure that, in any instance, that a realtor could confidently list a unit within a development or sell a purchaser unit within the development. And we put together a little list. And by the way, I should have said this earlier. If you guys have any questions, please add them to the chat. And that's a chat button at the top bar. You should see a top bar. You can ask any question you want about any of these issues, and I'm happy to answer them. And if we don't get to all of them during this presentation, I'm happy to answer them via email at a later date. Or if you want to hold off and ask me a question in the future, you'll have my contact information at the end of this presentation. But that being said, with a condo question, with this list, essentially, we tried to develop a process for a realtor, selling agent or listing agent within the development to kind of do their homework and make sure that development is, viable for lending. And I remember doing a call for a group of agents maybe 2 or 3 weeks ago where they said, well, this really isn't my job. And I said, well, it's kind of like anything else. If you want to be successful in this arena in selling condominium units and or listing condominium units, you kind of got to make it your job, because I would not want to spend my time as an agent listing a unit that had no chance of selling, right? You're not judged by how many listings you have. You're judged by how many sales you have. So if I'm listing a unit within condominium development, I don't want to keep that listing forever. I want that listing gone. I want somebody to go buy that unit, whether I sell it or whether another agent sells it. I want to make it easy for that process to happen. And very frankly, the realtors that are going to specialize here, and I got a couple of success stories on this side, which are really interesting. And if there's time, I'll share one. But I have some success stories from realtors who started contacting us and attended a seminar or two prior to the issuance of these guidelines, because we knew these were coming out in October, and we've been kind of working down the road of pushing this information into the industry, that have really really spent a lot of time focusing on this and focusing on sales and listings within condominium developments. And because they had this knowledge and because they were able to walk into these developments, in a lot of instances, I know two very specific ones where I have one real estate agent that listed 6 units within the same development because she went to the board and outlined these issues, and they essentially sent her information to every other unit owner within the building. It's like anything else, right? The person with the most amount of experience and knowledge is going to be the person in this realm that wins. So, not to delay this any further, what are our recommendations for you? Condominium questionnaires. You really want to make sure that a condominium questionnaire has been reviewed by the association or property management group, that they know about these new questions that are added, that they've addressed it in some way, shape, or form. You want to make sure that a condominium development has their condominium budget aligned with the 10% reserve line item requirement, and or obtains a reserve study. And we're happy to put you in touch with a reserve study firm that, should you need a reserve study, that can help provide one quickly in a development. If there are any special assessments, you want to make sure that the condominium board and or property manager has addressed them in their totality of what they're for, how long it's going to last, what the completion of work is, and if it's been performed, and what the actual special assessment is for. You also want to make sure that if there is any deferred maintenance or components that haven't been repaired or replaced, that the board has addressed that aspect of these new guidelines and has made plans to either complete that work quickly, or essentially had set aside enough cash to complete that work so that we could hopefully approve the site. And checking the unavailable list. Lenders really should check this unavailable list regularly. You could download the whole entire list. We try to do this once every 2 weeks to see what new sites have come on. If you're a lender, you can do this. But for a real estate agent, it's something that you would have to ask a lender to do for you, and to see if the project you're working in is on this new unavailable list that's been issued in the industry. So what are our services in the marketplace, just to outline them clearly for you? And again, any question you have about any of the information I just presented, I'm happy to answer in the chat feature. But CondoTech has a slew of services that we offer to different parts of the community, of the lending community and the sales community and the condo and co-op community. So we offer our Condo Pack product, which is essentially a one-stop collection of all the condominium documents. Typically, lenders request that is this product at the time when they've originated a loan. But there's no reason why a realtor and an agent couldn't request a Condo Pack on a condominium development when they're listing a unit. So that's something that we're starting to recommend. A co-op pack is the same thing for cooperative developments. We now offer a condo project warrant where you can order a review of all the condominium documents on the development to see if that building is compliant. And we're recommending that a lot of our associations or the condominium associations go through this process at least once a year to determine whether or not there is some sort of compliance there or compliance issue there. We offer direct portfolio, Fannie Mae, Freddie Mac, and FHA approvals. They're a little bit different dependent upon the association, but sometimes associations will come to us, condos will come to us and say, we need a Fannie Mae PERS approval, or we need an FHA approval, and we're happy to provide those approvals to associations. And we provide loan level compliance review for lenders. So that's primarily our main business, but those are all the services that we offer here. And again, if there is a reserve study that's necessary in development, we're happy to align any condominium association with a reserve study provider. There are some resources here, and I think Thomas is going to send this out to the group or send the presentation out to whomever is on this call. What I included here is the direct lender letter or the temporary guidance letters from both Fannie Mae and Freddie Mac. An FAQ link from Fannie Mae, which answers a bunch of questions. It's actually really well done. So there's a direct link to that site. And then the associated condo tech links that offer all our products, the condo project or warrant or the condo pack, or trainings as well. You can either contact me or Lisa Geloso, who's not on this call today, but for any questions regarding these new guidelines, or any questions regarding a specific condominium property, typically we ask that you go through your lender, go through Tom in order to get this information on a specific condo site. And he can absolutely walk you through this. He or anyone on his team can walk you through this process of approval and review on any one of your developments and or buyers. So that being said, are there any questions? Again, you can utilize the chat feature. We provided this presentation yesterday. If you do have any questions, please ask them. We're happy to answer anything you might want to discuss about a specific condominium development issue, or anything about the information I just presented. We'll give you a minute. If not, I don't know, Tom, you want to, anything else you want to outline or anything you want to discuss on this call before we end it shortly?
Well, first of all, I'd like to thank you. It's a great presentation just yesterday, and it is important to be in front of the curve when it comes to these new guidelines, because a lot of people wait until the last minute, and our reputations in this business is everything. This is why people call us, is because we make things happen, or we give them the accurate information so they can achieve the goals that they're looking to achieve. So again, I invite you to reach out to us if you have any condo questions. Reach out to Oris as well, and we look forward to working with you in the future.